What's up everyone, it's Caddy with MoneyVest. So in this video, we are going to be talking about our investing educational lessons. So this series continues where I basically take small nuggets from the books that I'm reading on personal finance, investing, and trading, and I share what some of the greatest investors of our times are talking about when it comes to investing, right? So these are timeless lessons that can be applied in any environment, any market condition, any time that you apply them, they're still going to be valid. And today's topic of discussion is going to be a concept known as style drift. I've talked about this in my MoneyVest Reads video where I break down the little book that beats the market by Joel Greenblatt. So again, make sure that you subscribe and make sure that you watch the videos at MoneyVest Reads channel. I've been posting shorts as well to help you again with understanding of what the book's all about, and again, timeless investing lessons as well. But style drift is basically a concept where an investor, right, more specifically applies to fund managers, but we're all really fund managers. If you think about it, we're all fund managers in our own world because we have capital, we have funds that we are managing every day, right? We're investing, we're saving, we're spending, we're making decisions with our funds, i.e. we are managing our funds, right? So technically we are all fund managers. We are capital allocators because we are, again, allocating capitals in the best possible ways because all of us want the highest rate of return with the lowest possible risk. That's the most rational way of thinking about investing, right? Now, style drift happens when an investor starts to ditch their existing strategy or their philosophy and starts to drift away from that and go towards something that he or she believes is going to be more lucrative. In other words, we start to drift away from our style and philosophy of investing and our process of investing to chase something that we find more attractive. And that happens on Wall Street all the time. And you know, very simple example I can give you is that let's say that there is a technology fund, right? There is a fund that specifically invests in technology stocks, right? That's their philosophy. That's their belief that technology is going to do really well in the future. That's their bread and butter, right? They want to invest in technology. They're known as a technology fund. But let's say that 1 year technology is having a very, very bad year, right? All tech stocks are destroyed. They're down 30, 40, 50%. And the fund is having a really bad year, but they start to witness that energy stocks are doing really well, right? Energy stocks are going higher. They're doing really well. Guess what they do? They start to sell their technology stocks and start buying into energy companies to take advantage of that momentum in energy stocks, even though it has nothing to do with their style of investing, their philosophy of the fund, but they want to chase those returns because they want to keep their fund alive and show their investors that they are beating the S&P 500 because they are invested in all these high-performing energy companies. And that's where style drift happens. And these are my notes that I wanted to go over from that book that I think are going to be very, very interesting for you. So after a few years of underperformance in the market, most investors look for a different strategy or a fund. In the investment world, we call this, quote, style drift. And style drift happens when the fund diverges away from its style of asset management to chase return. So again, think of it in your terms as well. As I mentioned earlier, we're all fund managers, we're all asset managers in our own lives. So think of it if you've done this, right? I've definitely done this in the past. I have, when I've looked at some attractive opportunities and some stocks that are doing really well based on that momentum, I've kind of ditched my style of investing and started trading, right? I've kind of switched that process and that mindset, and I've been, I've fallen for that as well. That's why I'm sharing these mistakes with you. For example, if a fund is strictly investing in technology stocks, but we notice that technology is having a bad year, but energy stocks are doing well, style drift would happen if we ditch our strategy of tech stocks and moved into energy stocks to chase those returns. And style drift happens all the time. And here are some of the reasons why it happens, right? So style drift is very common because it is very difficult to stick to a strategy, right? Because oftentimes investing is supposed to be boring, right? Investing is not supposed to be exciting. And I think I read a quote in the book Laws of Wealth also, where I can't remember who quoted this, but they basically mentioned if you are getting excited about investing, you're doing something wrong, because good Fundamental analysis and superior risk-adjusted investing is supposed to be boring, right? There's not a lot that we need to be doing every single day. Instead, we need to be making higher quality decisions, fewer decisions that lead to better outcomes, and it's supposed to be boring. So that's number one, right? That's very hard to stick to a strategy. If you are underperforming for 1 year, 2 year, 3 years, it becomes really difficult to stick to that strategy after seeing so much underperformance. And that kind of blends in well with peer pressure and social comparison as well, because, once we are underperforming, for example, let's say that 1 year, I do really poorly and one of my peers or someone that I look up to or one of my friends is actually doing really well in that year, then I start to get peer pressured as well. So that social comparison also plays a big role why their style drift could happen, right? And then short-term persuasion, again, if short-term there's a lot of different assets or different sort of strategies or different things that are doing really well, you get persuaded very easily in a time where you are underperforming, right? So investing is also not mechanical. That's another thing, is that the CAGR is a big lie, right? The compounded annual growth rate is actually a big lie because investing is not linear, right? It's never linear. It's never moving in this one straight line up. Instead, it is very cyclical. It is very periodical. And in other words, if you come over to this spreadsheet, which I've created for you guys, and what this basically shows is that let's say that we have 10 years, right? Year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And this is the S&P 500's price. 1 year, it could be down 18%. The following year, it could be up 22%. The next year, it could be up 8%, then down 3%, up 15%, up 8%, up 9%. You get the idea, right? It's all over the place. It's going to be up and down all over the place. It's just not linear. But if you take that compounded annual growth rate, what do you end up with? You end up with 6.74%, right? So that's going to be that number that you will see be quoted very often and be like, hey, yeah, S&P 500 gives you like 7% on average or 8% on average before inflation, whatever. That's what you can expect on a compounded annual basis. But of course, it is only a compounded annual growth rate number, right? Which can basically play with your psyche and be like, okay, I can expect to make 7%. But that's not always the case. That's almost never the case, right? Most often, markets are either more than 7% or a lot less than 7% in every single given year. And the interesting thing comes in that if you have a investing strategy, right? If you have a philosophy of investing in the markets, the bottom line is you have to stick with it. You have to see it all the way through before you make significant decisions about changing the way you invest, right? Changing your strategy. Because the thing is that you could, and in that book, they also talk about that you could be underperforming for 9 out of 10 years, right? Let's say that year 1, you make less than 10%, negative 10%, negative 20, negative 15, negative 2, negative 4, negative 19, negative 3. So all these years, you're losing money and you are making a lot less than the S&P 500. But guess what? If your strategy really pans out and it's really the 10-year philosophy, 10-year investing time horizon that you have, and in year 9, stock that you invested in or the strategy that you employed generated a 56% return, and the following year went up over 780%. Again, these are just hypothetical examples. Well, guess what? Your compounded annual rate is going to be 19.5% per year. But obviously, it's going to be with a lot of volatility, right? Some years you're down substantially. In fact, most years this strategy is down substantially, and some years it is up. And when it's up, it's like up an insane amount. But that doesn't matter because compounded annual growth rate is up over 19.5%. And most investors don't have the stomach or the will or the philosophy to stick to a strategy that's underperforming 8 years out of 10 years. You just can't do it, right? And that's exactly what's been talked about in that book as well, that most investors don't have the time, the money, or the psychology to basically withstand 9 years, 10 years, 15 years worth of underperformance only to see massive gains later down the road, which could end up being very substantial or returns that can really put you back on the map and generate more returns than the S&P 500. But it's just not feasible to expect 8 years or 10 years or a very long period of time of underperformance. That's why style drift happens so often, is that if you are underperforming, say year 1, year 2, you start to question yourself. You're like, okay, do I really need to stick to this strategy or do I need to pick something else? Do I need to start trading? Do I need to start momentum trading? Do I need to start maybe investing? Do I need to start options? That's when the confusion and the analysis paralysis begins. So, and I want to make a very clear distinction here as well, because I think there might be some confusion as well about this, that tactical allocation is not style drift, right? And that is if you already have that as your investing style and your philosophy is to be more tactical and more active in your approach, then if you are looking at opportunities in other asset classes and that's part of your investing sort of philosophy and your strategy in itself, then that is not style drift. Style drift is very specific to a process, right? It's a style, right? It's a style of investing or trading which changes significantly in order to chase returns and drift away from your current style, right? So it's not really if you are, let's say, getting rid of a stock because it's over allocated in your portfolio and you believe it's overvalued and you're buying an undervalued stock that you believe has a lot of potential. That's not style drift, right? That's simply a reallocation and a rebalancing of your portfolio while you're simply applying the same philosophy analyzing both stocks, and applying the same philosophy tells you that, okay, stock A might be overvalued, stock B might be undervalued, so you're kind of reallocating capital. That's not style drift. Style drift would be if you are basically going from becoming a long-term investor to becoming a day trader, right? Or basically diving into, let's say, crypto derivatives, right? Something that you've never really tried and you're just ditching your existing strategy because it's not working out, and you're going into something that is working for other people and you're chasing after that in hopes of making money in that strategy. So just wanted to break down this very interesting and very simple concept of style drift. Let me know your thoughts down in the comment section below. Again, a little bit of an educational video that I'm going to keep posting maybe once a week, once every other week, to kind of help you understand and, you know, just keep us all on the same page, psychology-wise, philosophy-wise. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe. First week of the month is the best time to join. We'd love to have you on board for our Patreon, for our Discord. And don't forget, fundamental tech analysis courses, 50 to 60% off. As always, happy investing. I'll see you all in the next video.